dealing in BFM. Okay. So what are we studying today? In BFM, we'll be studying cross currency plus some important parts about Treasury and Forex. Module A basically. So before starting, let's start with the regular motivational quote, because that is important nowadays. When obstacles arise, you change your direction to reach your goal. You don't change your decision to get there. Okay. Let any problem arise in your way. Never change your destination. Because the destinations one decided, you should move in that direction only. Okay. Then download Adda 24/7 app on your mobile to get all the details of various banking entrance exams. Also, the live classes as well as the study material is available for the same. You can use this code Y432 to avail flat 77% discount on the Adda 24/7 app for various CAIIB classes. Okay. So today, let's start today's topic. Today's topic is of basically cross currency and treasury, various important parts of Forex and treasury. What is chain rule? When is chain rule used basically? Chain rule is used means here, from example, you will understand it better. If I want the rate of euro versus yen, but the bank with whom I am dealing, it doesn't have euro versus yen. So how to come up with that rate? There are two options available. Either you tell the customer that we don't have euro versus yen and you go. You lose the customer. That is one way out. But is this allowed in today's banking? Should we do it? Should we let the customer go? No. When we can't let the customer go, we have to find a way out. How? So that is defined by chain rule. So what we do, we bring some X factor in between. So what is that X factor? That X factor is dollar versus dollar. Any currency which is globally traded. If some bank has, instead of dollar, if it has GBP, then it will do GBP, euro versus GBP to GBP versus yen. If some bank has some, let's say, Australian dollar, so euro versus AUD and AUD versus yen. So same currency should be brought in the denominator and in the numerator. So that is basically chain rule. Why is it brought only these 4-5 currencies which I am talking of, means dollar, GBP, yen, or AUD, Australian dollar, or euro? These 5 currencies are globally traded. So that's why what happens, if you bring something which is globally traded, then it becomes easier for doing the transaction. So how do we do it over here? See here, euro versus dollar, these both the currencies are globally traded. So what will happen? You will get the rates of this from the global market itself. But what about dollar versus yen? See here, yen is also traded, but this I can take the example of, let's say, rupees. Okay, rupees is not globally traded. So what happens? Indian rupees I am talking of, INR. So INR is not globally traded now. Of course, there will be some day where it will be a global currency like these remaining 5. Okay, we have the capacity for that, but let's wait for up to that time. So coming back, dollar versus yen or dollar versus rupees, this you get it from the local market. Now you have this from the global market, you have this from the local market. Just multiply it, this ratio, and you'll get the euro versus yen. Okay, that is the answer you get, euro versus yen. So chain rule means fixing the rate of exchange between the foreign currency and Indian rupee through the medium of some other currency is done by the method. So the rate thus obtained is called as a cross rate. Okay, so easy. Euro versus dollar and dollar versus yen, or euro versus GBP, GBP versus yen, something like that. Any currency which is globally traded. Remember, the above currency need not be globally traded. Means this can be dinar also. If I have to get the rate, let's say dinar versus rupees, INR. So what? Dinar versus dollar, dollar versus rupees. Okay, so dinar versus dollar, where will you get? You'll get in that country in which dinar is traded, right? You get it from there, and this you get it from India. So the markets for this means from where you have to get these rates? That is important. If these are globally traded, you can get it from anywhere. But both the currencies are not globally traded. Then you'll have to get it from the respective markets. Okay. Next. Now comes the various risks. And those risks means, like in JAIIB, we had all those defined risks. Here, how we'll study? We'll just study regarding how the things arrive. These are basically from the same Macmillan book. In the validated settlement of funds, there is a time lag between receipt of funds at one center and payment of funds at another center. Okay. So what do you mean the validated settlement of funds? Validated settlement means, suppose, let's say if today I'm doing some transaction in India right now. And what is the date today? Today the 18th. Now, if I have to give the funds in US to somebody on 18th itself. So how do we do it? How do we do it? Here, I'll buy the funds from India on 18th and give it to the guy in US. But there's a problem between India and US. The problem is day and night. Right now, when we have day and we have 18th, US is at night and before 18th night. So when we have night over here, then US will have the 18th date. Okay. So now this time lag of today's 18th over here and 18th over there, if something happens in between, within these 6-7 hours of working, if something big happens in the world and the rates are totally collapsed or they go very high, in that case, what will you do? Because you have booked the funds over here at X rate, and by the time it reaches US, means that US guy is to give the funds to somebody, the rates have collapsed. What will happen? In that case, here, interest should be paid to the party which is out of funds by adjusting the value date agreeable to both the parties. Means these situations are unseen. We call it force majeure. When we have this force majeure seen, then both the parties have to adjust the things. Okay. Next is arbitrage. Arbitrage means what? Simultaneous buying and selling a commodity in two or more markets to take advantage of the temporary discrepancies in prices. Okay. Now, what do you mean by this? Buying and selling in two or more markets. Can this happen? Immediately buying, selling. This can happen. How does it happen? Here. Let's say some of you might be dealing in share market, stock markets. We have two markets in India. One is NSE and second is BSE. Let's say right now, means if the market is working, let's say Reliance is trading in NSE at let's say 2400 and in BSE at 2402, the difference of 2 rupees. Now this difference 2400 and 2402 remains hardly for 2 to 3 seconds or 5 seconds. Max 5 seconds is out of question nowadays. 2 to 3 seconds, let's say. Okay, 3 seconds. So 2400 on NSE, 2402 on BSE. Okay, this 2 rupees difference. So what will I do? I'll buy at 2400 and sell at 2402 and immediately buy sell. So if I do the transactions immediately within the fraction of half a second, then I'll earn these 2 rupees. You'll say what happens in 2 rupees? But if I am an FII for an institutional investor and instead of buying 1 share of Reliance, I buy 1 lakh shares of Reliance or 1 crore shares of Reliance immediately and sell it immediately. So what happens? I earn 2 rupees over here. So 1 crore means 2 crores I earn immediately within a fraction of a second. So that is called as arbitrage. Arbitrage means always buying from one market and selling it in another. But that has to be done very fast when such discrepancies arise in prices. So that has to be done very fast. Okay. So that's why arbitrage is, everyone calls it risk-free, but the risk over here is only of time. If you waste almost 5 to 10 seconds, your arbitrage is gone. And the position you'll have to hold the position and take the hit. Okay. What are the types of arbitrage? There are 2 types of arbitrage. One is simple and second is compound. Simple means what? Only two centers involved. Two centers means what? BSC, NSC. Buying at NSC, selling at BSC. Buying at BSC, selling at NSC. Two centers. Compound means more than two centers. Means what? Suppose if I have to sell something in Africa, African market. Okay. So how will I proceed with arbitrage and buy it from India? Then buy over here, sell it in some global market, which is where everything is traded, and then buy from that global market and sell in that African market, right? That thing it has to be done. So that is compound. Okay. Generally, two centers arbitrage is simple way to do, and people do it very fast. Compound arbitrage requires a high precision and fastness in connectivity, because such operations may be carried out with a minimum time delay if the advantage is to be taken of the temporary price difference, right? Means time delay. Time is your only enemy in arbitrage. There's no other enemy in arbitrage. Markets usually tend to move towards such deals, and the difference gets wiped out, right? Means as you are saying that Reliance is at 2400 on NSE and at 2402 on BSC, the whole world is seeing it. So won't the world, all the traders try to buy that 2400 stock, isn't it? So what happens? And sell it at 2402. So this difference gets wiped out. This difference gets collapsed. It merges. Okay. So for transactions of TT, bill transactions, foreign money or cash transactions, different rates are applied. See here. What does it mean? If I am dealing in TT, telegraphic transfer, or bill transactions, okay, then the different rates are applied. Why? What is TT? What is bill transaction? See here. It's very simple. TT means telegraphic transfer. Telegraphic. We had that courier. We have that courier company. TT is just a courier company. Means what? Somebody from US has sent the funds. My bank in India over here. What will it do? It will convert those funds and give it to me. If it's my funds, obviously if it's my funds. So it will give it to me. So what that bank is acting? That bank is just acting like a courier agent. So it will charge similar to that of the courier agent. It can't charge more. But what is bill transaction now? Bill means risk. Now, what is this bill word actually? Bill means bill of exchange. Now, bill of exchange transaction means what? What is it in trade finance generally? Bill of exchange. Bill of exchange means I present a bill of exchange to certain bank, and that bank finances me based on the bill of exchange. Now, if the bank finances me on that bill of exchange, it means what? It is taking the risk. If you finance somebody, you will definitely take the risk. So what does it mean? If you take the risk, you will definitely charge more. And in TT, are you taking any risk? No risk. So you will charge less. That's why bill transactions have a higher rate than the TT transactions. Always remember. Okay. So that's why different rates are applied. Functions of Forex dealing room in Treasury comprise. Here, Forex dealing room in Treasury. What do you mean the Forex dealing room? There is a separate unit of Forex dealers. Now, what is dealers? Here, these are in front office. Always in Treasury, there are three types of offices: front, mid, and back. Okay, back office does the reconciliation, everything. Reconciliation means they don't do the individual transactions for. Okay, they don't come to the front end and buy and sell. They just do the reconciliation and reporting to various agencies. That's their job. What is the mid-level job? Mid-office job. Mid-office also doesn't do the transactions. Only the front runner does the transaction. So what does mid-office do? Mid-office gets the information from the whole world, whatever is required for use to that dealer, right? It's like this, means if some soldier is going on the front, what does the support agency do? It provides him with greatest information available and the best information available. So that is the job of the mid office. And what does that front office do? He is a dealer. Dealer means what? He is a soldier on the front. He fights. He buys some dollars, sells some dollars, buys another currency, sells another currency, buys some G6, sells some G6. All these things are done by that guy. Okay. So this dealing room means what? That's a front end room we are talking of. So what is the job of them? So their job is meet the requirements of the customers of other branches, divisions to buy or sell foreign currency. Means basically whenever, let's say, if you are working in a branch, so and you want to buy some Forex, some customer of yours has come and he wants to buy some Forex. Do you go and buy it from the market? No. What do? You inform your treasury by putting an email or whatever system you might be having. Okay. So that email or that system goes to this room, and then this guy or this department collects all the information from all the branches and then buys it collectively. It doesn't buy case-to-case basis. Okay. This is generally for retail. And if it's a big company, then only single company's transaction would be used, like Reliance. Tomorrow, Reliance wants to buy. It won't buy $1 or $2 or $100, $1,000. It will buy in crores. Okay. So meet the requirements of the customers of other branches, divisions to buy or sell foreign currency. Manage foreign currency assets and liabilities. This is very important. Managing means what? Here, every time if you want to buy, if your treasury runs to buy, some requirement is coming, so runs to buy this dollars from some currency. At that time, what the rate might be, that rate might not be fruitful to your customer. He'll say, hell with you, I'll move on. Okay. So in that case, manage the foreign currency assets means what? Your treasury has to take a bigger view and keep some foreign assets, means keep some dollars with them in their kitty always. Why do they keep those in their kitty? Because if some requirement comes in an urgency, they don't have to run. Okay. And they can utilize that. That's what. Fund and manage nostro accounts and also undertake proprietary trading in the currencies. So what do you mean by fund and manage nostro? What are nostros basically? Sure, there are three types of accounts, right? Nostro, vostro, and loro. So what is nostro? Nostro means my account with you. Means, let's say an example, I am an SBI in India. Okay. And I have an account with Citibank USA. Okay. So what is that called? Sure. From SBI India's point of view, that account is called as nostro, my account with you. From SBI India's point of view, it is called as nostro. But from Citibank USA's point of view, it is called as vostro, your account with me, right? So remember, it's nothing like nostro is different and vostro is different. The account which is nostro for some bank, the same account is vostro for the other bank. Okay, the second bank. And third is loro. Loro means what? Their account with them. Here, the guy who is transacting doesn't interfere in that account. Means third party account, right? We call that in Hindi we have this word begani shadi mein Abdullah Diwana. Same logic. Okay. Loro means one account we both are dealing, but we say that their account with them, some X party's account with some Y party. So this begani shadi, this is just a jovial part. But why is this loro account useful? This loro account is useful when we have to receive the funds, and these two banks who are directly transacting, means I am transacting, let's say, with some USA bank, okay, and I am an Indian bank. So when we are transacting with each other and we don't have a common account, then what do? Then in that case, we either look at our nostro accounts, means I might be having some account with X bank, and same with the same bank, the other bank who is dealing might be having that account, nostro also. Okay, means we both have nostros with one account only. Then it's easier. But if we both don't have the account with a common bank, then what? In that case, we use loro. You fund your bank account. I'll tell my bank to get the funds from that bank which you have funded. Or it's a complex transaction, but understand only one simple logic. Their account with them, loro. Nostro, vostro, I'm with you, and this vostro is you are with me. Okay. Qualities of and what was this proprietary trading? Proprietary trading means for the profits of mine. Means if I'm working in the treasury, my only job is not to fund this nostro, maintain asset level. I'll also have to earn something for the company. This earning for the company is always done through proprietary trading. I'll buy some dollars or any currency, government securities, and sell them at a higher price. Okay, so that's proprietary. Qualities required for a dealer. So risk-taking capacity, very important. Speed in decision making and willingness to recognize that one can be wrong. This is very important. See here. Risk-taking doesn't mean that you do any transaction. It doesn't mean that. Risk means calculated risk. That is important. Okay. If tomorrow I go and buy, let's say $1,000 or let's say $1 lakh, I'm working in the treasury. I go and buy $1 lakh. Why? Because I'm a risk taker. I'm not a risk taker. If I buy $1 lakh without any requirement, I am suicider. I'll suicide, means that's a suicide transaction for me, right? And even for my bank, because I'm putting my bank at risk. So risk taker means calculated risk taker. Okay. What will that risk taker do? He'll first look at the requirements of his customers and then buy 10% extra. That's a risk taker. Okay. But my customer's requirement of mine roughly comes to around, let's say, $100. And if I buy $120, that's okay. Okay. Means 20 will be adjusted here and there. Some new customer might come. But my requirement is $100 and I do buy something, let's say $300 3 times. Then I'm not a risk taker. I'm a foolish guy. I need not be there in the job. Right. So risk taking capacity, calculated risk taking. Speed in decision making and willingness to recognize that one may be wrong. Now, one may be wrong means what? It's general prerogative of any human being. Everyone feels two things. Always every human being in this world feels two things. One is nothing will happen to me. Everything will happen to others, not to me. Point number 1. And point number 2, I am never wrong. I am never wrong. In treasury or any Forex dealing or any stock market dealing where you are dealing in the options trading or future market, always remember you can be wrong. We are human beings. We are prone to errors. Okay. And the greatest trader or greatest Forex dealer is the one who immediately minimizes his risks and moves on. He doesn't stick to that whatever wrong has happened. He doesn't stick there. He moves on. That's the important quality of a dealer. Sticking to any transaction, sticking to any loss, that is wrong. Okay. Good understanding of the changing nature of things, ability to work under stress, willingness to accept responsibilities. Now, this is common. Ability to work under stress, it's a common trait for everyone working in any banking now. Okay. So, 2 positions of fund dealer are fund position and currency position. So, fund position and currency. What do you mean by these two? Fund and currency. Here, it's like this. Somebody of you, amongst you might think, what is the difference? Fund is in rupees, currency is rupees. So, what is this? Both rupees position. No, it's not that. Fund position is different. Currency here. How do we look at it? That's important. Here, currency for me is a commodity. Instead of considering this as currency position, you can consider this as, let's say, gold position. Okay. Its only important part, discrimination over here, is fund versus commodity. If somebody of you is dealing in stock markets, you'll always see that in any screen of that stock market, it gives you fund position of yours versus stock position of yours, because that's your commodity. Okay. So both the positions you'll always have to check, right? What do you mean by fund position? Peculiarities of fund position of a dealer are the fund's position reflects the inflow and outflow of funds. Okay. Means what are the inflows and outflows of the funds? How much funds have come in? How much funds have gone? you kindly check your stock market demat account, okay, there, or that trading account. You'll get the details over there. How many funds have come, ledger we get it, right? And what has gone out. So receivables and payables. Any mismatch in receivables and payables will throw open interest risk rates. This is very important. What do you mean by open interest risk rates? Here, if my funds means this funds position, if it's in a negative part, means what? I don't have money, but what happens? I buy some Reliance stocks or some dollars at a huge number of dollars. Let's say I had a capacity to buy $1,000, but I bought 5,000. So what will happen? Payables will increase. Now, if payables are increased and the market, Forex market or stock market or anyone, which is an organized market, that market doesn't at all forgive you. It doesn't forgive you at all. Means if you make a mistake, you'll have to pay for it. There's no other chance. If somebody of you might have dealt in stocks options, means call and put options, you might have learned this. Market never forgives you. So my payables are more. What the market will say? Market means the concerned authority will say, you have bought $5,000. You pay us within in spot. What do you mean by spot? Yesterday we had seen that. Spot means what? Spot means T+2, right? So they'll tell you, you fund our account in spot for the full $5,000. Then what will happen? If you are in spot and you are at a risk or you have bought the higher dollars, then what will happen? You'll have to buy the funds from the open market at a higher rate of interest. So that is basically interest rate risk. Okay. It may result in possible overdraft interest in the nostro accounts, right? So nostro will have to be overdrawn. Overdrawn means what? Again, the interest will be charged for that. Peculiarities of a currency position dealer are, it deals with the overbought and oversold position. Okay. Overbought and oversold means what? If I bought the dollars to the higher extent, or I have sold the dollars to the higher extent, both the things. Oversold means this is basically happens in short selling. Okay. And this is a long position, we call it overbought. So if I have overbought or oversold, arrived after taking various merchant or interbank transactions. So means this currency position deals with that. The dealer will be concerned with the overall net position, which exposes the dealer to exchange risk from market movements. So what do you mean by this? It exposes the dealer to exchange risk. Exchange risk means what? Suppose if I brought the dollars today, which were not required, and then this market will tell me, what will the market or the authority will tell me? You buy the dollars at any cost. If I can't buy, means if I can't fund the account, then what will they do? They'll sell those dollars which I have bought at some distress pricing or whatever pricing is available at that time. So that will always force me to exchange risk. Exchange risk means dollar to rupee the exchange rate. So that will always force me to this. Okay. So always this authority in between will force me to fund that account or sell the dollars immediately at whatever rates are available. Okay. So these were the two positions, fund and currency positions. Okay. So that was what I wanted to teach actually. Funds position. So what have we studied up till now in today's session? Fund position, currency position, then TT versus bill transaction, right? These are the key takeaways for you. Qualities of a good dealer. Then what is arbitrage? Then what is current chain rule? Currency, euro versus yen. This was an example. Okay. So again, I'll tell you, use this code Y432 to avail flat 77% discount on Adda 24/7 app. Okay. Download this app on your mobile to get the updates on various banking exams and also the course material and various video lectures. So bye from my side.